First, we will walk you through the current position of the fund, and then we will give you the repositioning strategy. We are looking at why we are going to do that and all the strategies behind it. But before I dive into that, I would like to walk you through my team.
Poner la computer.
So I'm Adi, and that's Austin, Alex, Ori, Arturo, and Jessica. And now, before I dive deeper, I would like to walk you through the first thing is the part of movie. And then for our relationship further. So our fund is an evergreen investment fund, which is 52% of our fund is allocated to apartments. The next asset class is garden style apartments. Also, we're looking at the fund characteristics in terms of that. So to begin with, high-rise apartments we currently hold are mostly on the local markets, which are the bigger markets and very strong hold of our portfolio. But we are kind of reaching a different point for our revenue. So that's the concern for us. And we also want to look into the upside of the SFR market, which is in current macro position, are kind of giving us a revenue and and then for us, the garden style apartment is more of a value-added proposition in the higher growth markets. And then affordable housing is more government subsidized. So we want to keep it in our portfolio so that our taxes are steady. And student housing is a peculiar asset because it's specifically to so we see and the last is land for development, which is currently under regulation. So my policy is to speak to how we will strategize that as an asset and how are we going to do a smart and strong way. So now I will hand it over to Rick. He will walk you through the current market macros.
Great, thank you, Adi. Yeah, so I'm going to be talking about the current market conditions. First, I'm going to be focusing on the outlook for interest rates and inflation. Thank you. So given what's going on in the economy right now, things kind of do seem uncertain. However, from some of the most recent data that we've analyzed from very credible sources like International Monetary Fund, we see that the economy is going to be entering into a recovery phase and enter more into a slow growth phase. So as you can see on the bar chart here, for the PCE and the CPI index, they're projecting that inflation has peaked in mid-2022 and really is starting to normalize around 2023 and 2024. And naturally, that's going to follow suit for the interest rates. As inflation goes down, so as the future hikes will also go down as well. So how is that really going to affect our fund moving forward? So we came up with three probabilistic scenarios. The first scenario is inflation peaked in mid-2022 following what IMF has projected and rates starting to normalize. So how is that going to affect our fund? During that time, asset prices should start to increase and really start to normalize. So that should also improve the overall fund liquidity. And as more deals and more acquisitions become readily available, we'd be ready to maneuver and make moves on certain deals that we see fit. The second scenario that we see is more inflation and less growth. In this scenario, we see our net operating income increasing as inflation is increasing because of the rent growth will most likely increase at inflation rate. However, the cost of debt will also increase because of future Fed hike rates. And so we'll most likely see a net decelerated change in cash flow. And in that scenario, we'll be adequately prepared because Alex is going to be talking about moving forward that we'll have a pretty strong cash position if that scenario were to happen, which is also giving us some flexibility moving forward towards the fund. The third final scenario, which wasn't really marketed that much or presented, but this is if everyone got it wrong and the economy does go into more a hard growth phase. In this scenario, our fund will continue to deliver the funds that we have been and beating out the current index right now. So overall, like, how do I look at our funds based on these three scenarios? I see us as relatively conservative, but also repositioning our current portfolio to really take advantage of a future market that we see in the single family market, where we can see high rent growth and a high possibility for a future for repositioning. So I'm going to pass it over to Jessica to talk about the single family market.
Thank you, Corey. Okay, so as Corey explained about the interest rate and inflation environment, all that being considered, we see SFR as the next big opportunity for our fund. As millennials have families and are growing, they're looking for more space. And unfortunately, they're finding that this particular aspect of the American dream is unattainable. So as you can see here, since 2019, the average home price has grown to over 6 times the median income. Additionally, over the past 3 years, mortgage rates have gone up 67%, and the average down payment has increased over 23%. So this means that millennials are staying in apartments longer or even staying with their parents much longer than they planned. So in short, homes are more expensive and millennials can't afford them. So not only are millennials being priced out of buying homes, they're also dealing with crushing student loan debt. So nearly 50% of millennials carry a student loan balance, the average of that balance being over $39,000. Additionally, millennials can't qualify for a lot of loans as the average FICO score is 92 points below the median at loan origination. Additionally, if you look at this bar chart, you can see that since the 2010s, the number of homes being built is at its lowest since over the past 40 years. Additionally, at the same time, we see occupancy rates increasing significantly over the past couple of years, and now they're hovering around 98%. So there's less supply, and the current supply is being occupied by people who are not leaving. So we see that as an opportunity for our growth. This is extreme shortage, and I want to dive a little bit deeper into the SFR market. I want to highlight a couple of strengths here. So one being the dearth of supply, and the second being low rate of turnover. So because of that, we see an opportunity for us to take advantage of the demographic trends and meet the demand that's not being met now, especially from institutional investors. We would like to be the first ones moving into this space. Now, there's one main weakness I want to highlight, and that's an exit strategy and operational knowledge. So our fund currently is only about 4% invested in this market. So we don't have the knowledge, and because it's so new, we don't have a clearly defined exit strategy. But we do have a mitigation opportunity that Arturo will talk about later. And lastly, I want to specify a couple of different threats. One being oversupply. That is a real threat. However, given where we currently sit, as I showed in the last chart, the numbers are being so low for so long, we see oversupply not being a concern until much further out into the future. And the last threat I want to highlight is regulatory risks. So the regulatory environment, along with the interest rate environment, in that third scenario Corey mentioned, where everything is rosy and interest rates go down dramatically, and all of a sudden millennials can afford homes, then this strategy wouldn't be quite as opportunistic. But we don't see that happening. As people who sit in that millennial generation, we see that as being very, very unlikely to occur. So the last thing I want to leave you with is, regardless of the macroeconomic environment, the SFR market has very strong fundamentals and is poised for growth. And and is something that our fund should take advantage of. So now Alex is going to talk about our strategy for actually grabbing onto this market.
Thank you, Jessica. So in dealing with the macroeconomic environment, as well as our research into the single family subsector, we've come away with two conclusions. One, we need to maintain a sizable liquidity buffer to deal with the uncertain inflationary environment that we're dealing with right now. The second is that we really need to get into SFR as it's going to be the prime driver of growth for the medium to long term. To that point, the first thing we would like to do is sell properties across subsectors in our non-core holdings, which include several of our high rises, a garden-style apartment complex, and industrial land to raise funds for this pivot to the SFR market. These liquidations will be worth about $230 million in gross asset value, and this will provide us with $125 million in cash and pay down $105 million of debt that's set to mature this year. All sales will close within the first 3 quarters of 2023. And we are projecting that we will only need to sell less than 5% of our net asset value in any given quarter to execute these sales. There's little risk of execution risk or the market freezing up with such low volume of transactions. From there, we will then take the proceeds and invest $500 million in gross asset value in the SFR subsector, or about 1,100 homes. This will be funded from 2 parts. One, we have $200 million from previous LP commitments that we've been assured are holding up even given the uncertain economic environment. The second is we'll take some of the proceeds in cash that we have raised and put $50 million into these purchases. At 50% loan to value, that's going to equate to $500 million in SFR. Additionally, we're planning a $20 million preferred equity investment in Sidewalk's operating company. This investment will be detailed further later in our presentation. Even after these investments, we will be maintaining $150 million dry powder for liquidity reasons and future investment opportunities. That's almost double our current $85 million of unrestricted cash. All these purchases are going to be closing in, well, the majority of them in 2023. A few of them will be in 2024, but our goal is by the end of 2023, we will be nearly ready to move on to our new portfolio outlook. Here's our cash sources and uses going forward. As you can see in years 23, 24, and 25, we will have a higher revenue coming in and going out. We are not really at risk of any liquidity events in this time period, and we're building up that liquidity buffer in case of a black swan event. Going from $85 million in cash to $150 million cash and transitioning into this SFR market is our avenue for growth. To that point, these accretive purchases and the secular market trends will increase the weight of the SFR portfolio from currently 4% to 30% by the end of 2027. Note that this assumes a 7% annual NAV growth in the SFR subsector for years 24 through 27. And also that there will be 10 to 15% declines in the coming year in the multifamily market at large. Currently, over 52% of our portfolio is in high-rise apartments. We consider that a concentration risk. By pivoting into our current strategy, we are going to be diversifying the fund such that no more than 38% is going to be in any single sector, and we believe we are going to be better positioned for growth within SFR and diversification and liquidity risks going forward. Arturo will now speak to us a little bit more about the Sidewalk investment.
Thank you, Alex. I want to take a quick moment to talk about Sidewalk. What do they do? Why do they call us an offer plus a deal, the deal that they offered us? And finally, I want to talk about why we're interested. So first of all, as we know, Sidewalk has 2 companies, the operating company and PropCo. The operating company has 80% of its revenue coming through management fees. Then the PropCo, what they do is they raise funds to then deploy in real estate assets, specifically in single family rentals. The deal that they called us to talk about was an opportunity to invest $20 million in their operating company with an opportunity to invest $100 million in the PropCo to deploy in real estate assets through their company. Of course, that sounds very interesting because as Jessica mentioned, there are not many companies out there that have experience in the single family rentals, and we are very interested in getting into that market. So another important thing that I want to stand out here is that Sidewalk is willing to negotiate their promote if we invest in both PropCo and NOPCO. So this is going to be very important for our objective and for our objectives and the recommendation that Austin is going to talk in a minute. So just so you have an idea, Sidewalk manages 3,200 units, and they have a value of $1.28 billion. So it's a pretty solid company with a lot of experience that we want to take advantage of. So now let's move on with Austin to talk about our recommendation.
Thank you. So we intend to strike a deal with Sidewalk that is different than what they originally brought to us. And the details of this modified deal are here on this slide. The important differences are this. Instead of a right of first offer on $100 million of equity, we want the right of first offer on $250 million worth of equity. The other big difference is the promote. We want a more favorable promote for us. We want to take this from a 15% of total profits to the GP down to 10% of total profits to the GP. And the result of this more favorable promote is a 208 basis increase in the IRR to us. And as you can see, we project this to be 13.96%. Now you're probably wondering, why would our operator agree to these terms? It's because we are going to offer them an amazing deal. Sidewalk, at the moment, their most pressing issue is that they need $20 million to fund their operating company. They're so desperate to get it that they were willing to part with common equity in this operating company. And that's where we step in. We are going to put in a $20 million preferred equity investment at a very fair 8% return. In addition, we are also going to take the management of all of our current single-family rental assets and shift management over to our operating partner Sidewalk so that they can further grow their business. In addition, we are also going to be lending them our credibility. Sidewalk has done an incredible job of raising money from high net worth individuals and family offices, but we are going to be their first institutional partner. We are going to be putting them on the map, so to speak. This is going to be sort of a breakthrough for their business, and this is sort of going to be the catalyst for them to be able to grow into the next stage. This is going to be an excellent deal for our operating partner. And I want to note that we did look into investing into the operating company, and that it is, potentially a very high return opportunity, but it's also only a $20 million equity check. It's really not going to be moving the needle on a fund of this size. Like even though the returns are very high, it's not really going to be affecting the overall fund's IRR. And so what are we getting from this? We are getting our most pressing needs met. The first of which is that we want to commit a large amount of equity into the single family rental space. We also want to make sure that we are working with a capable operator who has experience. And we also want to make sure that we are getting a favorable promote from this deal. And so the bottom line is, this deal is going to leave parties far better off than we were before. And that's why we are very confident that this deal is going to go through. And as you can see here, this is the returns of the promote that they came to us with and the returns of the promote structure that we are going to be getting. And once again, we are getting a 208 basis point increase in IRR towards us. I'm now going to pass this off to Adi to conclude the presentation here.
Thanks, Austin. So we just heard from my colleagues that there is a fundamental that's driving the SFR market. Sidewalk has a long-standing experience of SFR market, and we want to diversify. So given the fact, we also understand that we have certain risks and we need to come up with mitigants. So the first risk we envisage is overexposure to Sidewalk. But given the fact that Sidewalk currently holds 3,200 assets in SFR market with a net asset value of $1.28 billion and have 15 years of experience, and given their drive to come up with their own strategies, so I think we are confident and we see value in partnering with Sidewalk. And the second is redemption risk. We understand that current given macro conditions, there is apprehension around investors that liquidity is most important thing, but we would love to have them in our upside. And there is definitely fundamentals showing us that SFR is poised to grow, and we would love to have them. But in case they want to redeem out of the fund, As Alex mentioned, we have $150 million for the next 2 years as liquid assets, and we would redeem that in case of any need. And we will also, going further, we will keep on assessing our fund strategy and keep adapting to the market and kind of get to have this upside with us. So with this, I would like to open up for any questions and love to answer them. Thanks.
Right. So, I mean, when we actually modeled out the the opco opportunity, like they are generating a very significant return, but and for them that's great, and they're going to want to keep as much of that as possible in terms of equity. But then from our side, even if we have a $20 million deal that outperforms, we're going to have to do a lot of $20 million to actually commit the amount of equity that we need to commit. And so what we're really looking for is extra returns on the amount of money that we can invest in big chunks. And so that's sort of how that thinking came about.
Yeah, absolutely. So we're of the opinion that fundamentals have gotten worse in the last few months, but the market's not fully realized that just due to lack of transaction volume. So we are assuming that there's going to be anywhere from 5 to 15% NAV drops across the board through 2024. We think the market's going to stabilize by the end of 23. Personally, or not personally, rather, in our group, we thought that there was going to be a 10% drop across both the high rise and the garden style, and probably less so among student housing and affordable housing, only about 5%. As a result, we thought it's best to get to, if we're going to need to do a liquidity event, to get out of markets where there's likely to be a drop and try to get out of it sooner rather than later. That's why in the first 2 quarters of the year, we plan to be selling 2 high rise and 1 garden style. Additionally, right now our focus is primarily on residential. So the industrial assets that we own, while might be great developments, they're not really core to our beliefs. So we decided to also use them for liquidity just to have that cash reserve.
Right. I mean, ultimately, we are going to be forming a partnership. It's not, one of those situations where it's our way or the highway. Like, this is an operator that we really do believe in. They really do have an excellent track record. They really do have a lot of experience. And so there might be some room for negotiation. But generally, when we're trying to strike this deal, there are certain things that we're willing to offer. And one of the things that we'd like to receive in return is a slightly better promote structure. If you're asking if there's an exact number, I mean, in the course of negotiations, there is a number that will work for both of us. Right, and we're absolutely not going to be their only investment partner. We sort of have some familiarity with them. We actually imagine them to be breaking, into institutional money in the near future. But generally, that's just so that we can get a lot of our equity out, and hopefully with this partner, and hopefully at a relatively more favorable promote structure than what we have with our existing SFR operator.
To add to that point, just very briefly, we like the SFR market regardless if the deal goes through or not. So our target was anywhere from 20 to 30% of the portfolio being an SFR. What we currently model with 30% is the higher end, where that $250 million of equity is put in. However, as you said, the deals are not perfect. So maybe we would be doing 100 million with them and then try to allocate another 50 to 100 million with another partner as we find them.
So, I mean, obviously, it is difficult to deploy that much money in a relatively short time period, but we are predicting that we are going to get that equity out within our first 2 years of partnering with Sidewalk.
So I think since high-rise apartments are stronghold, which is we already our investors see that it's we cannot raise any more rents because it's like 31% rent to income for our clients. So we don't see the value going up for us in terms of steady cash flow. But at the same time, fundamentals show that SFR is definitely going up, and there is a lot of supply-demand mismatch. And given the fact that new developments won't happen overnight, and the fund is looking into 5 years. And within these 5 years, we are not going to see a lot of development coming up and suddenly getting that mismatch shortened. So I think our investors will get along with our idea to kind of re-strategize ourselves from high-rise towards SFR.
I would just add to you, like, I think SFR also is just part of our residential focus, like sectors, like it follows our investment strategy. But like, I also think the high-rise apartments that we were planning on selling off were part of the areas that were underperforming or cities that people were moving out to and kind of moving in different areas. So those were, I think if they saw like what our overall strategy was and what the potential return could be in that aspect, I think it would be advantageous for them to look at it.
And I'd like to also add on that, this fund is really focused on premium product. And that's why our original weighting was really towards, high rise in urban core. And we view SFR as, a premium product with lots of runway for growth that is going to be, here for the long run. So that's sort of the reason that we're willing to shift more into SFR.
So what's interesting here is that not many companies out there have experience that Sidewalk has in single family rentals. So as we said, like Sidewalk has over 50 years of experience. They have already a lot of units under management of that specific asset that we're looking. So therefore we feel like their track record is worth enough. It's good enough for us to trust them. So it's relatively a new kind of core asset that it's kind of growing into many different, like the mind of all the real estate investors. And therefore we want to invest in somebody who has that sort of experience that Sidewalk has. So that's key. The experience that they have, the fact that they already are doing it actively. And that's why we wanna trust in Sidewalk and we want to invest in them, as we see a lot of upside with that company.
And just to add on to that briefly, currently we have 208 SFRs in our portfolio, 4%. It's not a lot. We are not the experts in SFR, but we want to gain the expertise. Partnering with a partner who has a proven track record, knows what they're doing in the market, has 3,200 properties under management. We have the capital to provide, and we see this opportunity in the market. Several years down the line, when the investment does very well, we may reevaluate. Maybe we want to go out on our own at that point. But at least for now, we feel like partnering with Sidewalk is going to benefit both parties. And we can point to this, like once we learn how to do it, we probably won't need to partner with them. We can do it on our own.
Oops. So anyone, okay.
So if we didn't sell, we still have $200 million in LP commitments. So we would actually be able to fund still 80% of this deal, just not the 250 million. Now, granted, we have $85 million in cash at present, so we would still try to sell something just to raise our liquidity buffer, which we feel is very key. The returns are probably going to be pretty similar in the first year or two. I imagine the IRR is going to drop slightly because we've modeled higher growth rates in SFR than in the other sectors. But in terms of actually funding the deal, 80% of it's already committed with the LP commitments. It's just raising that cash for liquidity and then putting another $50 million in to get up to 250. That where we'd be not able to do as much.
And due to us, deploying this capital over due to us deploying this capital over 2 years, we are going to be able to execute on this plan, even if the market really slows down and we're not actually able to dispose of the assets that we need to. We actually have the cash on hand to both go after new opportunities, to pay down debt that's maturing, and then eventually sell these assets off, when they can be sold off.